Forget everything you've learned about Fibonacci, because the 61.8% level is not where smart money trades. It's where they trap retail traders. In this lesson, I'll break down a Fibonacci approach that actually aligns with institutional behavior, using liquidity sweeps and precision retracements to show you how smart money really trades around Fibonacci levels. So if you've ever wondered why Fibonacci works beautifully one day and fails completely the next, this video will finally reveal the underlying structure behind those moves. Before we begin, here's a quick disclaimer. This content is for educational purposes only and reflects personal opinions, not financial advice. Trading involves risk, and you should always consult a licensed financial professional before making investment decisions. With that being said, here's what you're going to learn in this video. Why the 50% and 61.8% Fibonacci levels are not reversal points but liquidity magnets used by institutions, how smart money turns Fibonacci levels into traps, and how to avoid falling into them, why Fibonacci fails for retail traders, and the simple shift that makes it work consistently, how to identify true premium and discount zones using Fibonacci and market structure, how to spot the smart money signature, the internal liquidity sweep that confirms institutional intention, how to avoid entering too early and wait for the only confirmation that matters, how to combine Fibonacci with top-down analysis so your trades align with higher time-frame direction, 3 complete Fibonacci trading strategies you can use immediately: a scalping model on the 1 minute, a day trading model on the 5 minute, a swing trading model on the 1 hour, how to apply all of these concepts to any market: Forex, crypto, stocks, indices, or commodities. Now here's something most traders never realize about Fibonacci. The 61.8% level and the 50% level are not reversal points. They're liquidity zones. Retail traders are taught to buy or sell at these levels. Institutions use these levels to trap them. Think about it. If millions of traders place entries and stop losses around 50% and 61.8%, what do institutions see? A perfect pool of liquidity, a perfect place to trigger orders, a perfect trap. So what happens? Price taps the 50% level, early retail traders jump in, institutions push price deeper into the 61.8% level, and that final push is where most stop losses are taken out. Then, once liquidity is collected, the real move begins. This is why Fibonacci works beautifully one day and completely fails the next. It's not about the 50% or the 61.8% level, it's about what smart money does around these levels. When you understand that 50% and 61.8% are liquidity magnets, you stop trading Fibonacci like a retail trader and start reading it the way institutions actually use it. Now that you understand why the 50% and 61.8% levels are liquidity magnets, there's something even more important to understand. Fibonacci doesn't fail because the levels are wrong. It fails because most traders use it on the wrong market structure. Look at this example. The 50% and 61.8% levels failed simply because traders used them inside the wrong structure. Let me explain. Here, the market was trending up until it stopped. Price entered a range, a distribution phase. At this point, buyers were no longer in control, so even if you pull a Fibonacci retracement and look for the 50% or 61.8% to continue the uptrend, it will not work. The structure has changed. Inside this range, you can clearly see a left shoulder, a head, and a right shoulder, a classic head and shoulders formation. This is a reversal pattern, not a continuation. So, expecting the Fibonacci levels to hold in an environment where the market is preparing to reverse is a recipe for failure. Once price breaks out of the range, it retraces back, breaks the support, turned resistance level, creates a liquidity sweep, and then drops. Every step confirms that the trend has shifted. So the problem was never the 50% or 61.8% Fibonacci levels. The problem was using them inside the wrong structure. When the market changes character, Fibonacci loses its meaning. Before you ever draw a Fibonacci tool, the market has already written a story, and if you misread that story, your Fibonacci levels become nothing more than colorful decorations. And here's the truth. To read the market story correctly, you must understand market structure. Without structure, every Fibonacci setup will fail eventually. No matter how perfect the levels look, structure is the foundation. Fibonacci is just the measurement. So let's break down the foundation. Because if structure is the story, then understanding structure means finally understanding what the market is actually trying to say. Despite all the noise, the market only has 3 voices: an uptrend, a downtrend, or a range. Every chart you will ever trade fits into one of these 3 structures, and once you can recognize them, Fibonacci stops being a gamble and starts becoming a translation tool. An uptrend is made of two parts: an impulsive move upward, a retracement downward. To use Fibonacci correctly, you must understand what causes each one. A range is a market moving sideways between a clear support level and a clear resistance level. Neither buyers nor sellers are in control. Why Fibonacci fails inside a range? Fibonacci needs a clear impulsive move, a clear retracement, a trending environment, but a range offers none of these. So when traders draw Fibonacci inside a range, they measure noise instead of structure. 50% and 61.8% levels become liquidity magnets, not entries. Price often breaks the level just enough to hit stops, then returns back into the range. This is why ranges are where most retail traders lose money with Fibonacci. Now that you understand market structure, here is the key rule. You only use Fibonacci during a trending market and only to measure a retracement inside that trend. If the market is not trending, Fibonacci becomes unreliable because there is no meaningful impulsive leg to measure. Let's go step by step with clear examples. Look at this chart of New Zealand dollar, US dollar on the 5-minute chart. The market is clearly moving downward. Every bounce gets sold and the price keeps breaking lower. This is a downtrend. Now focus on this strong drop. This is your impulsive leg. This is the only leg you should measure with Fibonacci in a downtrend. After that drop, the price pulls back slowly, not reversing, just correcting. This is exactly when Fibonacci makes sense. So you measure that impulsive leg from top to bottom, and you'll see the retracement climbing into the 50% or the 61.8%, rejecting the level and continuing the downtrend. Simple, clean, reliable. But here's the part most traders never see coming. Fibonacci works beautifully here, but in other situations it fails completely. And if you don't know why it fails, you'll keep losing money even when you use it correctly. So keep watching, because I'll show you the exact moment Fibonacci becomes dangerous and how to avoid the trap that catches almost every retail trader. Now look at the US dollar versus Canadian dollar on the 15-minute chart. Everything looks perfect at first. Buyers are in control, structure is clean, and the market keeps pushing upward. You've got a strong impulsive leg, you measure it correctly, from the swing low to the swing high, your 50% and 61.8% levels appear, and for most traders, this looks like the ideal Fibonacci setup. But watch what happens next, because this is the exact moment where traders get trapped. Price starts retracing just like in the previous example. It reaches the 50% level and early buyers jump in. It dips into the 61.8% level and even more traders enter long. And here's the mistake. Every one of those traders places their stop loss right below the 61.8% level, exactly where institutions expect it. The trap is already set. Instead of reversing at the Fibonacci zone, price pushes below the 61.8% level. And here's the part most traders misunderstand. Fibonacci didn't fail. The trader failed to understand the intention behind the retracement. This retracement wasn't clean. It wasn't natural. It wasn't a controlled pullback driven by profit-taking. It was engineered, it was a trap. It was a liquidity grab. Smart money knows exactly where retail traders buy and exactly where retail traders place their stops. So they use the Fibonacci zone as bait and the sweep as the trigger. Now that you've seen how Fibonacci fails during a retracement, let's make one thing clear. Fibonacci isn't the problem. The problem is that most traders don't understand how smart money uses liquidity. To avoid getting trapped, you need to know exactly what a liquidity sweep is and why institutions do it. Liquidity simply means areas where a lot of stop-loss orders are sitting. These spots are like fuel tanks for institutions. There are two categories of liquidity sweeps. This type of sweep typically occurs at the end of an uptrend, the end of a downtrend, or during an accumulation or distribution phase. Institutions sweep the highs or lows of a range to load massive positions before starting a new trend. This is not what we trade. This is reversal territory. Internal liquidity sweep. This sweep happens inside the trend during the retracement. This is the one that destroys many Fibonacci traders. Now let's look at a real chart example so you can see exactly how this works. Look at this US dollar, Japanese yen chart on the 1-minute time frame. Price is making a lower low, then a lower high, then another lower low. This is a clean downtrend. Sellers are clearly in control. Inside a downtrend, every strong push downward is your impulsive move, and every bounce upward is the retracement you want to measure. Focus on this bearish leg right here. This is the impulsive move that broke the previous low. This is the leg you should measure with Fibonacci. Only measure meaningful moves, not tiny swings. Now take your Fibonacci tool and measure from the swing high down to the swing low of the impulsive move. Your chart now shows two key levels, 50% retracement and 61.8% retracement. These are the only levels we care about, but we're not selling them blindly. We're waiting for the liquidity sweep. Here's what happens next. Price starts pulling back, just like a normal retracement. It approaches the 50% level, and most retail traders sell immediately. We don't. We wait. Price pushes deeper into the 61.8% level, and here's the important part. It goes above the 61.8% just enough to clear all the stop losses sitting above the Fibonacci zone. And then a candle closes back inside the zone. This is the moment institutions step in. Retail traders who sold too early get stopped out, while smart money enters their short positions from the premium zone. Now that you understand how to use Fibonacci retracements together with liquidity sweeps to time your entries, let me show you something even more important. Look at this chart. The market is clearly moving down. Impulsive drop, retracement, another impulsive drop, another retracement, perfect environment for a Fibonacci pullback setup. We take our Fibonacci tool and measure the retracement from the swing high down to the swing low of the impulsive move. Two levels appear, 50% and 61.8%. Most traders ask, which level will hold? But that's the wrong question. In a downtrend, 50% and 61.8% together form one area, the premium zone. This is where institutions want to sell because this is where price becomes expensive again. So instead of picking one level, you draw a zone from 50% to 61.8%. This premium zone is your selling area, but only after one more key signal. Watch what happens here. Price retraces into the premium zone, but instead of reversing immediately, it pushes above the zone and takes out the stops resting above it. This is the internal liquidity sweep. This is where retail buyers get trapped. Institutions push price above the zone to collect liquidity, and once they're filled, the market shifts direction again. The entry is simple. You wait for price to close back below or inside the premium zone after the sweep. Why? Because that closing candle confirms the sweep is complete and sellers are back in control. This avoids early entries and traps. Once the candle closes back below or inside the zone, the market continues downward exactly as expected and moves straight toward your target. Now let's flip the script and look at the buy-side version, because the logic is the same, just inverted. Look at this chart. Price is trending upward. Impulsive move, retracement. Impulsive move, another retracement. A clean and healthy uptrend, the kind institutions like to build positions in. Now focus on this impulsive leg. This is the one we measure with Fibonacci. You measure from swing low to swing high. Two important levels appear, 50% and 61.8%. In an uptrend, the 50%, 61.8% area becomes the discount zone, the zone where price becomes cheap again for institutional buyers. We don't guess which exact level will hold, we treat the entire area as one single smart money zone. Price begins to pull back, this is normal, this is healthy, it moves down into the discount zone, and this is where retail starts buying early, but you don't. You wait for the liquidity sweep. Watch what price does here. It dips below the discount zone just enough to clear stop losses sitting under the recent swing low. This creates sell-side liquidity, perfect buying conditions for institutions, a spike in available sell orders for smart money to buy. This is the internal liquidity sweep, the trap that clears the weak hands and fills the smart money's orders. Then you get the key signal, a candle closes back inside the discount zone. That's your entry trigger. Entry, as soon as price closes back inside the discount zone after the sweep. Stop loss, below the liquidity sweep wick. Target, aim for a 2-to-1 reward to risk ratio. Since this is a new impulsive move, it is likely to break the previous higher high, so we place the target slightly above that high to secure the full 2-to-1 ratio. Now you understand why the 50% and 61.8% zones fail, you understand how institutions use them, and you know how to use them the smart money way. But here's the part most traders never expect. Even with this strong foundation, your Fibonacci strategy will still fail unless you apply one simple trick that changes everything. And I'm telling you right now, this trick is what separates a winning trader from someone who keeps wondering why their perfect setups fail. Even the best Fibonacci setup collapses if you're trading against the higher time frame direction. This is the mistake almost everyone makes. So here's the rule. Always confirm your Fibonacci setup using top-down analysis. If you scalp on the 1 minute, use the 15 minute as your higher time frame. If you day trade on the 5-minute, use the 30-minute. If you enter on the 15-minute, use the 1 hour. If you trade the 1 hour, use the daily. If you trade the 4 hour, use the weekly. Why? Because Fibonacci is a micro tool. Trend direction is a macro truth. When they agree, your win rate skyrockets. When they disagree, your setup fails, even if it looks perfect. Now you understand the foundation, structure, liquidity, and higher time frame direction. But even with all of this, Fibonacci will still fail unless you know how to apply it in a real trading strategy. So, next, I'll give you 3 practical models you can use immediately. One for scalping, one for day trading, and one for swing trading. Each one uses the same smart money logic, just adapted to the time frame you trade. Let's start with the first scalping strategy. This is the British pound US dollar on the 1-minute chart. As you can see, the market is trending up, higher highs, higher lows, so buyers are clearly in control. Here we have a resistance that turned into support. Price retraced, dipped below that support, and then closed back above it. That's your liquidity sweep. Once the sweep completed, the market pushed up again and created a clean, impulsive move. Now price begins another retracement. So we draw our Fibonacci retracement from the swing low to the swing high to identify the discount zone, the area between the 50% and 61.8% levels where smart money wants to buy. We also mark the support level because it will help us later. Watch what happens next. Price retraces into the discount zone, sweeps below it, rejects the support, and closes back above the zone. That sweep is the smart money signature. It confirms that this Fibonacci discount zone is not just a number, it's a real buying area. Now we jump to the 15-minute time frame. On the 15-minute chart, price tapped into a strong demand zone and rejected it aggressively. That tells us the higher time frame is bullish, exactly what we want before entering the 1-minute setup. Back to the 1-minute chart. We enter at the close of the candle that moves back above the discount zone. Stop loss goes below the support level. Target is the next resistance. And as you can see, price moves straight to the target, giving us a clean 2-to-1 reward to risk ratio. Now let's move to the day trading strategy. Look at this chart. This is US dollar, Swiss franc on the 5-minute time frame. The market is clearly trending upward. Impulsive move, retracement. Impulsive move, retracement. Higher highs and higher lows show that buyers are in control. Look left. Here we have a resistance level that turned into support. Price broke above it, retraced, dipped below that support, and then closed back above. That's our first liquidity sweep. After the sweep, price pushed up again into another impulsive leg. That impulsive move creates a new support level. We mark it because we'll need it later. Now we draw the Fibonacci retracement from the swing low to the swing high of the impulsive move. This gives us the discount zone, the area between the 50% and 61.8% levels. Price enters the discount zone and reacts. But remember, we don't buy reactions, we buy liquidity sweeps. Watch what happens next. Price breaks below the Fibonacci discount zone, rejects strongly, and then closes back above the zone. This is the liquidity sweep we were waiting for, the move that confirms this discount zone is a real smart money area. We also have confluence. Price retests the old resistance, turns support, and rejects it perfectly. Everything aligns: smart money discount zone, liquidity sweep, trend structure, Fibonacci confluence, and support rejection. Now we check the 30-minute time frame. On the 30-minute chart, price is ranging between a strong support and resistance zone. Price just rejected the support and is likely to travel upward toward the resistance. That move, support to resistance, is exactly what we want to capture on the 5-minute time frame. Back to the 5-minute chart. We enter at the close of the candle that sweeps below the discount zone and closes back above it. Stop loss goes below the sweep wick. Target is twice the risk. We place the target slightly above the resistance because if price breaks that level, it will often continue pushing higher before any retracement. And as you can see, price moves straight to the target, giving us a clean 2-to-1 reward to risk ratio on this setup. Now let's move to the swing trading strategy. This is the 1-hour Ethereum chart. And by the way, the strategies I'm sharing work on any financial market. As you can see, the market is clearly trending downward. Impulsive move, retracement. Impulsive move, retracement. Here we have another impulsive move and price is starting to retrace. So this is the perfect time to draw the Fibonacci retracement to find the premium zone. Once we draw the Fibonacci from the swing high to the swing low, we get the premium zone, the area between the 50% and 61.8% levels. Now watch what happens. Price reaches the premium zone and rejects strongly, but if you sell here, you lose because your stop loss will get hit. Our strategy does not enter on simple reactions. We wait for the liquidity sweep inside the premium zone. Here we finally get it. Price spikes above the premium zone, grabs the stop losses sitting above the structure, and then closes back below. This is the smart money signature, the internal liquidity sweep. This confirms that institutions are selling from the premium zone. Now we switch to the higher time frame, the daily chart. On the daily, the market was trending up and is now in a retracement. This is the resistance turn support level that price is likely to revisit on the daily time frame. So does this go against our trade on the 1 hour? No, because the daily still has room to drop into that support. One daily candle is made up of 24 1-hour candles, and on the 1 hour time frame we usually need only 4 or 5 candles to reach our take profit. This is why we use that daily support level as our directional bias and as the logical area toward which the 1 hour move is likely to flow. Back to the 1 hour chart. We enter at the close of the candle that completes the liquidity sweep. The stop loss is placed above the sweep wick. The target is 2 times the risk. We don't need to aim for the full daily support, we simply take profits with a clean 2-to-1 reward to risk ratio and stay safe. And as you can see, price moves directly to the 2-to-1 target, exactly as expected. If you watched until the end, you now understand Fibonacci the way institutions use it, as a timing tool, not a guessing tool. You know how to read structure, how to spot liquidity sweeps, and how to align your trades with a higher time frame. This content is for educational purposes only and reflects personal opinions, not financial advice. Trading involves risk, and you should always consult a licensed financial professional before making investment decisions. If this lesson brought you clarity, make sure you subscribe, hit the like button, and turn on notifications, because the next videos will take your trading to an entirely different level. Thanks for watching, and I'll see you in the next lesson.